Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me at MarketSet, we have Brian Joyce, as a managing director on Nasdaq's market intelligence desk and also a resident chart technician. Thanks so much, as always, Brian, for joining us. Let's take a look at a couple of these charts that we have up here today, seeing a little bit of potential weakening here. If we look at the S&P over here, you've identified a pattern and you're seeing some weaker breadth within the market.
Correct. So the S&P yesterday was just 4 points away from making fresh all-time highs, typically a very bullish signal, especially if you're just following the price. But looking underneath the surface, you can see that when we made new highs back in January of 2018, 34% of the index was also making new highs. Back in September of 18, when we then made new all-time highs from there, just 12% of the members of the S&P 500 were making new highs. So that was your bearish divergence right there. And what happened next? We had a 20% correction, the biggest correction that we've seen since roughly 2011 or so. So here we are again. We've rallied back to those highs that we saw in September. And again, less than 12%, about 10% of the members within the index are making new all-time highs. So you want to see confirmation from a growing number of participants, not a less number of participants. So it's just a reason to be cautioned right here. I think the index, even if it breaks out to new highs, if we don't see the breadth grow with that, or expanding breadth at least, then I would be cautious about the move and maybe look into some defensive types of options.
Is that part of the reason why intraday trade has been relatively muted, kind of sideways, and not much volume? Is that part of that?
I think the reason for the less volatility is just that you look at the chart overall over the last 4 months, it's been a straight move higher. There's been very little corrective price action, and so as a result, you're just seeing less volatility because of that. We're seeing in the FX market, there's a lot of reduced volatility as well, and even in the Treasury market in rates. So I think that's something that eventually will reverse. It always does. And when we do see that reversal in volatility, the question is it good volatility, or is it that bad volatility like we saw in the fourth quarter, which leads to market makers kind of pulling back and the whippy, gappy price action?
It seems like the price action has been, over the past couple of years, anytime you do get those vol pops, it has been like very, very rickety. It's not like a consistent kind of market.
Correct, and that I think transitions well into this next chart here for the dollar, which is, as we saw yesterday, the dollar basket broke out to new highs. This is really a large weighting towards the euro, which is about 58% of this basket. So really, the euro versus the dollar is the key driver here. So the dollar is breaking out to new highs after, let's say, 6 to 7 months of range trading. So typically what we expect to follow from here is continued move to the upside. The reason why this chart, I think, is very important is because, not seen here, but the ranges that we've been seeing with the dollar are very tight, very narrow. The Bollinger Bands for the euro-US dollar are at 40-year lows. So if that is now going to expand, that can really lead to powerful momentum. And if the momentum here is to the upside, I would be cautious, particularly if I'm invested in overseas markets like emerging markets, because the strong dollar is typically seen as a big headwind. And if this is going to be, or if this is the early stages of a strong move to the upside for the dollar, then certainly I would be cautious about, say, China and other emerging market areas. And
which have had quite a run. Another chart that we don't happen to have up right now, but interest rates, that could be like the trifecta, the three reasons why you might be a little bit concerned about equities right now.
Right, so looking again at the intermarket analysis, the rates, what's going on there, they are trending lower. They have been for a large part of this move higher up here in the S&P 500, largely driven on expectations that the Fed is now on the sidelines. I think this new downtrend that we're seeing right now is noteworthy. Last week, the 10-year Treasury yields began to roll over. It actually was moving higher intra-week, but then pulled back, closed near the bottom of the range, formed what we call as a gravestone doji pattern, which is being confirmed this week by a bearish engulfing pattern. So I do think we could revisit the recent lows we saw in late March, which was around 230, 235, and probably go lower than that.
All right, we need to get you on for a Charts 101 so we can take a look at what all these different patterns are. Brian, as always, thank you for joining me for some chart talk. Thanks for joining me on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.